Ahern video podcast this week is part 3, selling your transportation company. So in the last 2 series, we've talked about having an evaluation on your company to make sure that it reaches your expectations, but more importantly, it's based upon market conditions. 2, we've talked about preparing yourself to mentally prepared to let go and have something to do with the next phase of your life. 3, we also discussed if you're a trucking company that has assets, to make sure that the equipment is properly appraised. 9 out of 10 times the equipment is overinflated. I said don't go out and create a lot of expense on an appraisal if you're a small trucking company. Simply just go to your truck dealer and say, look, I'm doing my estate, blah, 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 and get the orderly liquidation and the fair market value for the equipment. Do not use insurance values. They're totally irrelevant in the sale. The next part, and the most crucial part, is putting your team together. You've decided that the market is ready for you. You are ready for the market. You've decided that if you can achieve a market value for your business, you're ready to let go. Then you have to make sure that you have the right team. You need someone strong in accounting and someone strong in legal. But you need to make sure that you control their costs, and you also have to make sure that they know what their job is. Their job is to not get in the way. Their job is to protect your financial interests, but not make it so difficult that you don't cross the finish line, and their job is not to run up the meter. So until you get a letter of intent, which I'll explain that in a minute, you keep those people out. A letter of intent is a non-binding contract. It's based upon reviewing the financial information, reviewing operation statistical information, reviewing the add-backs, and saying, okay, if we can complete our due diligence process and all of these things that you have given us, we can firm up, then we're willing to pay you X for the business. Once you get that letter of intent, you may want to show it to your accountant to find out what the tax issues are. But more importantly than that, until you get a contract to purchase, you really shouldn't bring the attorney involved. When the contract to purchase comes in, your attorney is to redline it. He's not to send it back to the buyer's attorney, because then the buyer's attorney will make some changes and send it back, and it'll keep going back and forth. They get on the phone, they make all the discussions. That attorney does not make your decisions for you. You make your own decisions. There is no contract that's iron tight. It's got to be a fair contract. If it's a one-sided contract, it's not going to be work. There's no way that a seller or a buyer can protect themselves 100%. So there has to be a certain amount of trust factor. In reference to the valuation of the goodwill, it's really based on earnings, and there's a lot of variables. If you're an asset-based business, and let's say you're $25 million and over, you can use a multiple of EBITDA. And that's a fancy term that nobody ever knew in the trucking industry what it was till private equity came into our space 6 or 7 years ago. But it's a term that's loosely used. EBITDA doesn't mean that you're going to get $1 gazillion, because each buyer is different. But let's say that your EBITDA was $4.5 million, and let's say that you received an offer of 4.5 times. And let's say that was $20-something million. So you say, okay, I'm going to make $20 million. No. Even if it's an asset sale, there's going to be several components to the deal. The components are, you're going to keep your cash, you're going to pay off your trade payables. You're going to pay off your debt, not just your trade payables, your debt. Is the equipment going to go along with it? No, not in a multiple of EBITDA normally. Remember, I'm talking normal. In an asset sale, normally, you're going to value the equipment, you're going to value the receivables, you're going to value the debt, and that's going to give you your net liquidity position. Then you're going to place a value on the business. If your company is small, you can expect to receive 2 to 3 times your average earnings plus your assets less your debt. If you get a multiple of EBITDA, you can expect that they're going to keep the equipment. In all cases, 99% of the cases, they're never going to buy your terminal property. They might lease it with an option to purchase. So that's phase 1. Phase 2 is if it's a strategic buyer and you're large enough, then they're going to want you to stay for a 2 to 5 year period. And there's an employment contract, and there's an incentive part. There's an incentive portion to the contract. So that's phase 2 of the agreement. And then 3, there's a lease on the terminal if you own one. If you're a non-asset based business, And let's say you're $20 million and up. You can get 6 times EBITDA plus your assets less your debt. Some cases there'll be a working capital adjustment. Some cases there will not. Depends upon who the buyer is. If you're a larger company, the EBITDA can go up. If you're a smaller company, you still might get a smaller freight brokerage. You still might get a multiple of EBITDA, but not if you're at $4 or $5 or $6 million. You're going to get a multiple of earnings plus your assets less your debt. If you want to stay, then you get a separate employment contract. Those are basic formulas that you use. Those are basic formulas that you can use as guidelines. Everything can change, but don't think you're going to reinvent the wheel. Don't think that you're going to deal with a buyer and you're going to say, I am that diamond in the rough, because 9 out of 10 times. Now, there are some variables that can increase your cost, and I'm going to talk, that can increase your price, and I'm going to talk about that next week. Thank you for attending the podcast.